Welcome back to the Deep Dive. It is Monday, February 2nd, 2026. And honestly, we need to take a deep breath before we get into this one. We're covering the Q4 2025 earnings from a company that, they basically invented the modern office, but right now, looking at the ticker, feels like the market's trying to evict them. We are talking about Xerox.
It is definitely a grim Monday for anyone holding that stock. The ticker is XRX, and if you weren't watching late last week, you'd think your data feed was just broken.
Yeah, let's just rip the Band-Aid off right at the start. The stock didn't just slide, it plummeted. We saw a 12.45% drop in one day.
Yeah. Last
Thursday, it closed at $2.04. Just think about that. $2 for a share of Xerox. You can't even buy coffee for that anymore.
It's historic and not in a good way. And the scariest part wasn't just the price, it was the volume. Nearly 10 million shares traded. That's about 2.6 times their normal daily average. That tells you this wasn't just algos adjusting. This was people running for the doors.
It feels like a panic. And that is the central mystery we have to figure out today. Because if you actually listen to the conference call, which we did, so you don't have to... The CEO, Steve Bandrowczak, sounded okay. He was talking about improving trends, tangible synergies, how the integration of Lexmark and IT Savvy is like ahead of schedule.
Right.
So you have the CEO saying the plan is working and the market saying, get me out of here. Mm-hmm. That is a massive disconnect.
It is the absolute definition of a credibility discount. We see this happen when management is selling a very complex turnaround story, but the core business is behaving like a melting ice cube. The market has just reached a point of fatigue. They're saying, we are tired of promises about next year. Show us the cash today. And, when you peel back the layers here, the cash just wasn't there.
So let's dissect the numbers, because Messi doesn't even begin to cover it. The headline number, the one that flashes on the screen, was a massive miss. They posted an adjusted loss per share of 10 cents. The street was expecting a profit of 29 cents.
That is a huge swing. It's a 39-cent delta. In this world, missing by a penny or two is bad. Missing by 39 cents when you were supposed to be profitable, that's catastrophic. And that's just the adjusted number. The JAP number, which has all the messy stuff in it, was a loss of 60 cents a share.
But here's the part that I think tricked a lot of people up, and I want you to walk me through this. Revenue was $2.028 billion. Technically, that's up 25.7% year over year. So revenue up 25%, stock down 12%. I think that makes sense.
And this is exactly where you have to be careful with headlines. That 25% growth, it's entirely inorganic. Remember, Xerox went shopping. They bought Lexmark. They bought IT Savvy. That revenue growth is there because they wrote a check for it.
So they just bought a bigger top line.
Exactly. But the metric that really matters to an investor is pro forma, or organic revenue. So if you pretend they owned those companies last year too, how did the combined business do? On that basis, revenue was actually down 9.0%.
Ouch. Okay, so that changes the entire picture. It's not a growing company. It's a shrinking company that bought some friends to make the party look bigger.
That is a very apt way to put it. And the core engine, the legacy print business, is shrinking faster than the new acquisitions can grow, and that drag is hitting profitability hard. Adjusted operating margin fell to 3.5%, which is down 140 basis points. But the real killer, the number that likely caused that 12% drop, was free cash flow.
Cash is king.
Always. For the full year, free cash flow was just $133 million. That is down $334 million from the prior year. When you're a company with debt, trying to fund a pivot, and you burn through that much cash, the market gets very, very nervous about liquidity.
Okay, so the financials are ugly, less cash, shrinking organic demand, a surprise loss. But management didn't just shrug their shoulders. They had reasons or, excuses. Let's talk about the headwinds.
They pointed to two main external factors. First, they cited government uncertainty, the SLED, sector, state, local, and education. Basically, they're claiming that after all the budget fights, spending just froze up.
I got to push back on that a little bit. Sure, government moves slow, but is that a Xerox problem or a macro problem? Did we see Microsoft come out and say, hey, the government stopped buying software?
That's a fair question. We haven't really seen this cited as a primary excuse by the big software giants. It suggests that when budgets get tight, the first thing to get cut isn't the cloud contract, it's the copier upgrade. It sort of speaks to how essential the product is.
That makes sense. Easier to delay a new printer than to shut down your email.
Yeah.
Okay, the second excuse really caught my eye because it was so specific. They called out rising memory costs a spike in DRAM prices.
Right. And this is actually crucial because it highlights the identity crisis Xerox is going through. 5 years ago, who cares about DRAM prices at Xerox? But now they're trying to tell us they aren't a copier company anymore. They are an IT solutions company.
This is the pivot.
This is the pivot. Through IT Savvy, they're reselling servers, laptops, all that stuff. Those devices are packed with memory. So when DRAM prices spike, their margins get crushed. The CEO is basically saying, look, we're an IT company now, so we have IT hardware problems.
Yeah. It's a double-edged sword. You get into a new market, but you inherit all its headaches.
Yeah.
They did talk about how they're trying to counter this. Cross-selling. They have 200,000 existing customers who buy toner. The goal is to sell them cybersecurity, too.
They even mentioned a specific new offering called TriShield 360, a cybersecurity package partnered with Palo Alto Networks.
On paper, I get it. You have the customer relationship. But in practice, I don't know, it feels like asking your plumber to fix your Wi-Fi. Just because I trust you with the pipes doesn't mean I trust you with my firewall.
And that is the exact skepticism the market has. But to be fair, they didn't just talk in abstractions, they brought a receipt. We have to talk about the Morrison's deal because this was the bright spot they kept coming back to.
Yeah, let's unpack that because usually these calls are full of vague wins. But Morrison's is a massive UK grocery chain. We're talking 500 supermarkets, logistics sites, and Xerox won the contract.
And it wasn't just a print contract, this is why it matters. It was a joint win for Xerox and Lexmark, and it covered the full stack. They're doing print infrastructure, yes, but also digital marketing through their Go Inspire unit and on-site operations.
Why is that specific combination so important?
Because it's the proof of concept. It proves the sales force can actually walk into a major company and sell the one company vision.
Yeah.
They didn't just sell copiers, they sold a whole solution. If they can replicate that Morrison's deal 500 more times, then the turnaround is real.
So it shows the plumber can fix the Wi-Fi, at least at one grocery store.
In this one instance, yes, it validates the strategy. The question is, can they scale it?
They also threw in some AI updates. Because it's 2026 and you legally have to mention AI on an earnings call now, they have an AI Center of Excellence.
I know, the name is so full of buzzwords.
I honestly brace myself whenever a legacy company says Center of Excellence. It usually means a room with like 3 interns and a ChatGPT subscription. Yeah. But they actually described a use case that I thought was legitimately clever.
The counterfeit toner thing.
Yes, using probabilistic modeling to protect their supplies revenue.
It's really smart, and it hits the bottom line. The Xerox business model is razor and blades. Sell the printer cheap, make money on the toner, but cheap knockoffs kill that margin. So they're using AI to analyze usage patterns and find where those fake cartridges are leaking into their ecosystem.
It's basically AI forensics for ink.
Exactly. If they can stop even 5% of that leakage, that is pure profit. It's not flashy, but it's actually useful for their business.
Protecting the ink money. The most Xerox application of AI I could possibly imagine. Okay, let's shift gears back to the financials because things got a little weird in the CFO office. New CFO, Chuck Butler from Lexmark. And he had to explain some very complex moves.
Yeah, Chuck has his hands full. The numbers were messy, partly because of what they call one-time impacts. They sold finance receivables in Portugal and France.
Okay, pause.
Yeah.
Sold finance receivables. That sounds like jargon. What does that actually mean?
It's often called forward flow. Imagine you have a contract where someone owes you $1,000 a month for the next 2 years. That's an asset. But you need cash today. So you sell that whole contract to a bank for, say, $22,000 up front.
So it's kind of like a payday loan for a corporation.
In a sense, yes. It brings cash in the door right now, which makes the balance sheet look stronger this quarter. But the downside is you don't have that steady income next year.
Feels like pawning the silverware to pay the rent.
It can be viewed that way. It's a move you make when liquidity is the top priority. It spooks investors because a healthy company usually doesn't need to rush to sell its future income.
And speaking of moves that spook investors, we have to talk about the warrants. I read this part of the transcript 3 times. Xerox announced a special distribution. 1 warrant for every 2 shares you hold.
This was definitely the head scratcher of the call.
I need you to explain this to me like I'm 5. If I own Xerox, I want a dividend. Cash. Why are they giving me a warrant? That feels like an IOU.
It's actually more like a lottery ticket. A warrant is basically just an option. It gives you the right to buy more stock at a specific price in the future.
So if the stock stays at $2,
then the warrant is worthless. You get nothing. It's just a piece of paper.
So why do it? Why not just do a buyback or pay a dividend?
Because they're cash poor. Remember that free cash flow number? They can't afford to write a check to shareholders, but they're worried that if they give shareholders nothing, the stock will fall even further. So they print these warrants, cost them $0 today, and it tells investors, hey, stick with us. If this turnaround works and the stock goes to $5, this warrant will be worth a fortune.
It feels like a move you'd see from a distressed SPAC or some penny stock, not a 100-year-old company.
That is exactly why the market reacted so badly. It signals that the board views the company as a speculative turnaround, not a stable dividend payer. It forces conservative investors to hold a derivative they probably don't want or understand.
It just adds to that distressed value trap vibe. Which brings us to the future. Despite all this, the mess, the weird warrants management gave guidance for 2026 that is surprisingly sunny.
It is strikingly optimistic. They're forecasting revenue over $7.5 billion, adjusted operating income between $450 and $500 million. And this is the big one, free cash flow of around $250 million.
So they're saying ignore the $133 million we just did.
Yeah.
Next year, we'll almost double it to $250 million.
Basically. They claim they've baked in all the headwinds, the hit from Xerox Financial Services, the memory costs. They are betting the farm that the synergies, the cost cuts from the Lexmark merger, will generate $200 million in profit improvement.
Synergies, the magic word.
If they are right, and that is a massive if, then the stock at $2 is ridiculously undervalued. But the market, by sending the stock down 12%, is clearly saying, we think you're hallucinating.
It's the credibility gap. They missed by 40 cents this quarter, so why should anyone believe the spreadsheet for next year?
Precisely. The burden of proof has shifted entirely to them.
Let's zoom out for a second and look at the investor context. Because if you've been holding Xerox, it has been a brutal, brutal ride.
Understatement of the year. Over the last 12 months, Xerox is down about 74%. In that same period, the tech sector, the XLK, is up 25%. The S&P is up 17%.
That is a massive divergence. They're completely decoupled from the market rally.
They're being priced for irrelevance. The narrative shift they're attempting is to go from a dying print company to a durable cash flow turnaround. But right now, the market just sees a falling knife.
So as we look toward Q1, what are the metrics that actually matter? What should we watch?
Forget adjusted EPS. Ignore the noise. Watch three things. 1, synergies. Are the cost cuts actually showing up in the bank account? 2, cash flow. Are they tracking toward that $250 million target? And 3, the pivot. Can they actually sell enough laptops and security packages to offset the decline in printing?
It really is a race against time. They have to build the new business before the old business sinks the whole ship.
And the water is rising fast.
All right, that brings us to my favorite part of the show. The part where we get a little creative. It is time for our This Is Not Financial Advice segment.
The standard disclaimer, we are just podcast hosts, do not trade based on this. We are pitching wild ideas for entertainment. Please do your own due diligence.
Okay, I've been staring at these numbers all weekend, and I've cooked up something that is either brilliant or absolutely toxic. I'm calling this trade the paper jam hedge.
I'm already nervous. Lay it on me.
Okay, look at this situation. Everyone hates the stock. It's down 74%, left for dead. But management, the insiders, are handing out these warrants. They're essentially betting on their own resurrection.
Right, they're incentivized to get the stock price up.
So here's the play. Forget the stock. The stock is boring. We buy the warrants. They're likely trading for pennies right now because of the crash. If the CEO is wrong and the company goes to zero, you lose pennies. Who cares? But if he's right, even a little bit, those warrants act like leveraged dynamite.
You're hunting for asymmetry. Tiny downside, massive potential upside if they pull it off.
Exactly. But we need insurance. So we pair it. Long the warrants, short the memory supplier.
Oh, that is interesting. You're connecting it back to the CEO's excuse.
Exactly. The CEO specifically called out rising memory costs as the threat. If DRAM prices keep spiking, Xerox's pivot dies, but maybe your short on a memory company works out. But if DRAM prices crash, your short might hurt, but Xerox margins improve, potentially lighting the fuse on your warrants.
You're hedging the input cost. That is insanely specific, but it's logically sound.
I've got another twist. Long Xerox warrants, short the office REITs.
The return to office play.
Think about it. If Xerox stabilizes, it implies people are actually in offices printing things. Great for Xerox. But if offices stay empty, Xerox probably goes to zero, but your short office REIT position prints money. You're hedging the physical office itself.
I have to say, the paper jam hedge is mathematically intriguing. The warrants are basically a cheap call option on a management team that the market thinks is delusional. If they're even half right, the re-rating would be violent.
High risk, high reward. Just how we like it in this purely hypothetical world.
Purely hypothetical. Please do not mortgage your house for Xerox warrants.
Definitely not.
Yeah.
So to wrap this up, Xerox missed big. The stock crashed to $2. They're using financial engineering and warrants to stay afloat, but they're promising a much brighter 2026 based on synergies and IT services.
The new CFO has a clean slate, but that warrant issuance suggests they need to get creative to keep investors around. They're walking a tightrope between a successful pivot and a total liquidity crunch.
And we will definitely be watching to see if they make it to the other side. That's it for this deep dive. Remember to check your own risk tolerance before you go playing with falling knives.
And maybe check if you really need to print that email.
Thanks for listening. Make sure to subscribe for the next earnings breakdown. We'll see you then.